Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tenet Healthcare Corporation Annual Report. Tenet Healthcare Corporation offers a wide range of healthcare services through its various business segments. The company operates two main segments: hospital operations and services and ambulatory care. Under the hospital operations and services segment, Tenet provides general hospitals that offer acute care services, including operating and recovery rooms, radiology and respiratory therapy services, clinical laboratories, and pharmacies. These hospitals also provide specialized services such as intensive and critical care units, cardiovascular services, neurosciences, musculoskeletal services, obstetric services, and pediatric quaternary care services. In addition to its general hospitals, Tenet operates acute care and specialty hospitals, off-campus emergency departments, imaging centers, urgent care centers, and microhospitals. The company also offers a range of procedures and services through its ambulatory surgery centers and surgical hospitals, including orthopedics, total joint replacement, spinal and other musculoskeletal procedures, gastroenterology, pain management, otolaryngology, ophthalmology, and urology. Furthermore, Tenet provides various specialized services such as cardiovascular services, neurosciences, musculoskeletal services, obstetric services, pediatric quaternary care services, and telemedicine access services. The company's ambulatory care segment offers a range of outpatient services, including physical therapy, imaging technology, surgical robotic, and minimally invasive cardiac valve replacement. Overall, Tenet Healthcare Corporation provides a comprehensive range of healthcare services through its various business segments, making it a leading diversified healthcare services company in the United States. The significant increase in Tenet Healthcare Corp's stock price by over 68.86% in the past year can be attributed to several key news events. One major factor was the company's strong fourth quarter and full year 2025 results, which exceeded analyst expectations. Tenet reported adjusted earnings per share of $4.70, surpassing forecasts of $4.02, with revenue reaching $5.53 billion. The company also provided a positive financial outlook for 2026, projecting net operating revenues between $21.5 billion and $22.3 billion. Another significant event was the completion of a strategic transaction with CommonSpirit Health regarding Conifer Health Solutions. This deal involved payments totaling approximately $1.9 billion from CommonSpirit to Tenet over 3 years, providing Tenet with greater flexibility to support Conifer's long-term potential and leading to incremental earnings in 2026. Tenet's commitment to growth through strategic acquisitions also contributed to the stock price increase. The company acquired controlling interests in 27 ambulatory surgery centers and 1 surgical hospital, expanding its highly profitable ambulatory care segment. This segment consistently generates higher margins than inpatient services and has been a key driver of growth. Additionally, Tenet strengthened its balance sheet by actively returning capital to shareholders and refinancing its debt structure. The company repurchased approximately 943,000 shares for $198 million in the fourth quarter of 2025, and a total of 8.8 million shares throughout 2025 for $1.39 billion. These efforts have likely boosted investor confidence and contributed to the stock price increase. Tenet Healthcare Corporation market capitalization of $20 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Tenet Healthcare Corporation holds a significant advantage in their industry. Tenet Healthcare Corporation trades at a lower price-to-earnings ratio of 16 times and a higher price-to-book ratio of 4.78 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. Net income and profit margins experienced significant fluctuations between 2024 and 2025. On the negative side, net income decreased due to increased regulatory actions, fines and penalties, as well as impairment charges and restructuring charges. Additionally, a 23% decrease in net income was attributed to higher interest expenses. The net income margin also declined from 19.7% in 2024 to 11.1% in 2025. However, there were instances of increased net income, including a $1.386 billion boost due to a share repurchase program and a $973 million increase, or 6.5%, compared to the previous year. Net income also rose from $473 million in 2024 to $534 million in 2025. Profit margins underwent changes as well. The operating income margin decreased significantly, while the hospital operations segment's operating income margin increased. Conversely, the ambulatory care segment's operating income margin declined. Overall, these fluctuations highlight the complexities and challenges faced by the company in terms of net income and profit margins. The company's financial performance is a testament to its ability to generate significant operating cash flow. As evident from the data on page 83, the company has consistently demonstrated a positive trend in its operating cash flow over the past 3 years. In 2025, the company generated an impressive $3,540 million in net cash provided by operating activities, indicating a substantial increase from previous years. This upward trajectory is also reflected in the results for 2024 and 2023, where the company reported $2,047 million and $2,374 million respectively. The consistent generation of positive operating cash flow across all 3 years suggests that the company's operations are efficient and profitable, enabling it to generate significant amounts of cash from its core business activities. This is a clear indication that the company is on solid financial ground, with a strong ability to meet its financial obligations and invest in growth opportunities. The company's debt level has undergone significant changes over the past few years. Initially, there was a substantial increase in debt since no previous data was available for comparison. However, this trend was not consistent, as the debt level remained relatively stable on page 27. The redemption of certain notes led to a decrease in debt by $2.25 billion, but the issuance of new notes resulted in an increase of $1.5 billion. Despite these fluctuations, the long-term debt, net of current portion, showed a slight increase from $13,081 million in 2024 to $13,092 million in 2025. However, this trend was short-lived as the total long-term debt decreased from $13,173 to $13,092 by page 109. Regarding interest expenses, there has been a significant change due to the issuance of new notes with different interest rates and the redemption of existing notes with higher interest rates. The interest expense decreased from $826 million in 2024 to $821 million in 2025. However, the interest paid increased from $851 million in 2024 to $865 million in 2025. In summary, while there have been fluctuations in debt levels, the overall trend has been an increase. In contrast, interest expenses have decreased due to changes in borrowing rates and note issuances. The management of the company has outlined its strategic focus areas that will shape its outlook in the coming period. One key aspect is the emphasis on providing value-based care services to various clients, including hospitals and health systems. This approach aims to deliver high-quality care while controlling costs. To achieve this goal, the company plans to reduce net operating revenues through implicit price concessions related to uninsured patients and those with copays, coinsurance, and deductibles. Additionally, management is investing in debt securities to meet cash requirements, demonstrating a cautious approach to financial planning. The company's restructuring efforts have been ongoing for several years, resulting in significant charges. However, these efforts are expected to yield benefits from operating efficiencies and growth strategies. The adoption of new accounting standards will also lead to incremental disclosures, but no material impact on the financial statements. Overall, the management strategy is centered around delivering value-based care while managing costs and investing prudently. Despite acknowledging uncertainty around future financial results, the company appears committed to its strategic objectives. The company has made several strategic moves through acquisitions and divestitures to restructure its business. In terms of acquisitions, the company has expanded its presence in the healthcare sector by acquiring 27 ambulatory surgical centers, ASCS, one surgical hospital, and an additional ASC with a non-controlling ownership interest. This move is expected to enhance the company's capabilities and increase its market share. On the other hand, the company has also engaged in divestitures as part of its restructuring efforts. Specifically, it redeemed $1.5 billion worth of 6.25% senior, secured second lien notes due February 2027, and $750 million worth of 6.125% senior notes due October 2028. These moves are aimed at optimizing the company's financial position and reducing debt. The company's financial history reveals a commitment to shareholder value. One notable aspect of this commitment is the payment of dividends, which demonstrates a willingness to distribute profits to investors. This practice not only rewards shareholders, but also signals confidence in the company's future prospects. In addition to dividend payments, the company has also engaged in share buybacks. By repurchasing shares from the market, the company reduces its outstanding share count and potentially boosts earnings per share for remaining investors. This strategic move can be seen as a vote of confidence in the company's growth trajectory and a way to create value for shareholders. That concludes the financial summary for Tenet Healthcare Corporation. Feel free to comment below, and I will be happy to answer them when possible.